Hello guys, so let us move on with our class of FRA. So today specifically we are going to do the income tax. There is 12 income tax. There is 12. So we shall talk about the meaning of the income tax, and then we shall talk about the differences that will, arises, that is the permanent difference and the temporary difference, and then we shall do a question. Once you're done with a question, then we shall dive into deferred tax. So under the deferred tax, we shall talk about the balance sheet liability method, which is the recommended method. And under deferred tax, we shall come up with a formula for determining the deferred tax, and that is the temporary difference times the tax rate. Then we shall see how to determine the temporary difference, that is the carrying amount minus the tax base. Then we shall see how to determine the carrying amount, that is the cost minus accumulated depreciation. Then the tax base, that is the cost minus accumulated capital allowance. Then we do another question. Then we talk about the disclosures and the income tax. So welcome. So as you can see in the board, that the income tax, so income tax refers to the tax that is payable during or after the financial period. So it is either you pay within the period or after the financial period. That's the meaning of the word income tax. So when we compute or when we calculate the income tax, there are differences which arises. Those differences arises because of the taxable profit and the accounting profit. So for taxable profit, this is the amount of profit that is taxable by the revenue authority. Then we have the accounting profit. The accounting profit is the profit that is determined from the normal operation of the business, from the normal operation of the business. Now, because of the differences between taxable profit and accounting profit during computation, arises two items. That is the permanent difference and also the temporary differences. So permanent difference is where it arises when an item has been considered in one profit computation and ignored in another profit computation. And a good example is depreciation. Now, depreciation from the tax class, public finance. So depreciation is treated as an expense in a normal computation of profits. But when we compute the taxable profit or the taxable income, depreciation is considered as disallowable expense. So it is not considered. So it is considered in computation of accounting profit, but disallowed or ignored in computation of the uh, taxable profit. And that in that case, it relates to what we call the permanent differences. Then you have the temporary difference. The temporary difference arises in a situation where profit computation is considered in different time period. So arises when the item has been considered in both profit computation, but in different time period, in different time period. A good example is the income and the expenses. Now, income for accounting is considered on accrual basis, but when it comes to a computation of tax, it is recognized on cash basis. So same accounting period, same different time period, but the same item is considered. So different time period, but the same item is considered. So i.e., income and expenses are recognized in the accounting profit on accrual basis, but recognized in taxable profit on cash basis. So the same amount is considered in different period. For the accounting, it is considered when the item has been incurred. even if the cash has not been paid. But for the accounting, for the taxable profit, it is only considered when the cash has been received. Now, temporary difference is the difference between the carrying amount, and the tax base. So the carrying amount and the tax base. So how do we get the carrying amount? This is how you get the carrying amount. Carrying amount, carrying amount is the amount which is the net book value, or the amount as at the balance sheet, is equals to cost you less the accumulated depreciation. So cost minus accumulated depreciation. Then we have the tax base, TB, is equals to cost minus accumulated capital allowance, capital allowances. So that's how you get the the tax base, the temporary difference. Sorry, the temporary difference is equal to the carrying amount minus the tax base, and the carrying amount we have said is the difference. So in case they ask you to define what is carrying amount, you shall say that the carrying amount is the difference between the cost and the accumulated depreciation. Accumulated depreciation, while the tax base is the difference between cost minus accumulated capital allowance. Let's see the type of income tax. So we have two of them. So income tax is uh, the different. We have two different two type of the income tax. So we have the current tax and we have the deferred tax. So the current tax, we shall do a question for the current, this one, April 2023. That will be a question for the current tax. Then we shall, once we finish current tax, we shall do deferred tax. Then we do a question also on the same. So let us see what is the meaning of the current tax. Now, current tax is the amount of income, is the amount of income taxes payable for the period. Payable for the period, for the current period. So tax paid during the current period, or you can say, refer to the amount of income tax, refer to the amount of the income tax that is payable for the period. And then how do we get the current tax? Current tax is equal to the taxable profit. You know how to compute taxable profit. Equal to the taxable profit times the tax rate. Taxable profit from the times the tax rate. Tax rate is the rate which is applicable in the location where you are. So in Kenya it is 30%. So in Kenya it is 30%. So how do you get the taxable profit? From the taxation point of view, taxable profit. So we take the reported profits, then we add disallowable expense, then we less capital allowance. And our capital allowance is the allowable deduction. Allowable deduction. Then we shall get taxable profit. We shall get our taxable. We shall get our taxable profit. So that's how you compute it. So our taxable profit will be given as, we take the reported profit, we add disallowable expense, then we less the capital allowance, which is allowable deduction, then we shall get our taxable profit. So in financial reporting, we shall only consider those items. We shall only consider those items. I think we are done with the current tax. Let us talk about the deferred tax. So deferred tax, these are the future tax obligation. They are future tax obligation. Or you can say, you can also have another definition here for deferred tax if you want another definition. Deferred tax. Deferred tax, we shall say that deferred tax refers to the amount of income tax recoverable. Amount of income tax recoverable to the amount of the income tax recoverable in future period. In future period. In future period, in respect to what? In respect. So in respect to the following item. So we have 3 items. In respect to the following items, number 1, deductible temporary difference. Deductible temporary difference. And then carry forward of unused tax loss, of unused tax losses, and then carry forward of unused tax credit, unused tax credits. But we can use this one. So these are the future tax obligations. So they can either be tax payable or they can be provincial for the taxes for the next period. Provincial for the taxes for the next period. Now for the deferred tax, we shall stop up to this point. But for now, we do this question for April 2023. April 2023. April 2023. Question number 5B. So April 2023. Question number 5B. April 2023, question number 5, boy. So let us do this question for April 2023. April 2023, number 5B. So April 2023, question number 5B. April 2023, question number 5B. April 2023, question number 5, boy. So April 2023, question number 5, boy. The question reads, BXL, the Manufacturing Ltd, a firm that engage in production of fertilizers, purchase an item of equipment. So we have a PPE of 12 million. So we have property, plant and equipment, 12 million. Then the company provide a depreciation on equipment on straight-line basis at the rate of 25% per annum. Now depreciation, because it's on a straight-line basis, it means that depreciation is the same from 1 year to another. So 25% of 12 million. So how much will be the depreciation? So that will be equal to 0.25 times 12 million, which is 3 million. So this depreciation will be the same from 1 year to another. So that depreciation will be the same from 1 year to another. Then during the 4 years from 1st July 2018 to 30th June 2022, profit after tax and allowable wear and tear for tax purpose were as follows. So we have been provided with the profit after tax and also the wear and tear, WTA. So that's from 2018 to 20. So that's which I said from 2019 to 2022. So 2019 to 2022. So shall have our years. So we have years. So we shall say 2019, 2020, 2021, and 2022. Then we start with the reported profit. Reported profits. Now the reported profit for 2019 is 2,427. 2,400. We have 2,700. We have also 2850, 2850, and 2550. Now, because part number 1, so part A, this we are doing part A. We are required to to determine the taxable profit. So remember how to get the taxable profit? We take the reported profit, that is the profit after tax. We add depreciation because it's our disallowable expense. So add depreciation expense because it's our disallowable. So this one is in million, in thousand. This one is in thousand because you can see it is in thousand. So meaning this one will be 3 million. We add back 3,000 will be the same throughout the year. 3,000. Then we are supposed to less the capital allowance. So we less capital allowance. That's the way I end it here. Capital allowance. Now let us complete the capital allowance. So year one, it is 40%. So number one, 40% of the cost. Cost is 12 million. So we shall put in thousand because the question is in thousand. Year two is 30% of 12 million. Year three is 20% of 12 million. It is on cost. Then year four, 10% of the cost. 10% of the cost. How much would that be? That one will be equal to, the first one is 0.4 times 12,000. That is 4,800. So we deduct 4,800. The second one is 30%. 30%, that's 600. That's 600. Then you have 20%, which is 2,400. Then the last one is 10%, 1,200. So we shall get what we call a taxable profit. Taxable profits. So 24 minus plus 3,000 minus 4,800. So this is 600. 2,700 plus 3,000 minus that 600. That is 2,100. 2,850 plus 3,000 minus 2,400. 3,450. Then you have 2,550 plus 3,000 minus 1,200. That is 43,50. Now we can get our current tax. Current tax. It is equal to taxable profit. Taxable profit times the tax rate. Tax rate. Multiplied by the tax rate. So meaning it is 600. The first one to be 600 times 30%. 180. Then 2,100 times 30%. So it's 630. Then you have 3,450. Then 35. Then 4350. That is 1305. So that is the tax, current tax. So that will represent the current tax for the period 2019, 2020, 2021, and 2022. And 2022. So that part A is done. Let's go to part 2, deferred tax. Deferred tax. So before we do the part 2, the deferred tax, I want to take you through something else. So you allow me to take you through the deferred tax. Then, once I take you through the deferred tax, we shall do part B of that question. We shall do part B of that question. Part B of that question. So let me take you through the deferred tax first. deferred tax. So let us see this table. You can see we have a table there. So that one is for purposes for the deferred tax only. Now before we do that question part B, let us see the deferred tax. Deferred tax. Now deferred tax, um, it is viewed as to arise because of temporary difference. So deferred tax mostly arises because of the issue of the temporary differences. Now, deferred tax is equal to the temporary difference. You multiply with the tax rate. So you multiply with the tax rate. So when you get the temporary, this is the temporary difference. For example, let me highlight it in red or black. So this is our temporary difference. This one, temporary difference. When you multiply with our tax rate in Kenya is 30%. 30% we shall get the deferred tax. The deferred tax. So the deferred tax can either be categorized into two. So you have the deferred tax liability or the deferred tax asset, depending with the situation. So the situation can relate to deferred tax asset or the deferred tax liability. Now, so the temporary difference minus times we multiply with the tax rate. You multiply with the tax rate. Now remember our temporary difference is the carrying amount minus the tax base. We did it in our previous as we started this topic. Then the carrying amount we say is the difference between the cost minus accumulated depreciation, which is the same as the net book value. Then you have the tax base, which is the cost minus the accumulated capital allowance, which is the same as the written down value, the WDV. So this is the net book value, NBV, and this is the written down value. That is from the capital allowance. Now you have two type of temporary difference. The one which arises because of the accounting for assets, and those which arise because of the accounting for liabilities. Now, if the carrying amount is greater than the tax base, now let us see this here for asset. So for asset, if the carrying amount is greater than the tax base, if the carrying amount of an asset is greater than the tax base, let's go with the greater than the tax base, then it will lead to what we call the deferred tax liability. It will lead to what we call the deferred tax liability. Same for assets, if the carrying amount is less than the tax base, it will lead to what we call the deferred tax asset. Now, if we take for the accounting for liabilities, if the carrying amount is greater than tax base, it will lead to the deferred tax asset. Now the opposite. Then if the carrying amount is less than the tax base, it will lead to what we call the deferred tax liability. So you need to know that one. So you need to know that one for the purpose of computing, the deferred tax assets or the deferred tax liability. So I think we can do now part B of that question. We can progress to the part B of that question. So let us do the part B of that question, which is very important. Very important. So the question is still the question for April 2023, question number 5B. But now in this case, we shall do part B of that question. We are going to do the part B of that question. So let us do the part B. Part B of that question. Part B of that question. Now, before we continue to part B, yeah, there's an important note. We have an important note here that we need to highlight. Number one is the intangible assets. Now, intangible assets are not capitalized for tax purposes. Sorry, are capitalized. Supposed to be, they are capitalized. So intangible assets are capitalized. So intangible assets are capitalized for tax purpose based on the tax base. Based on the tax base. What does it mean? So if the intangible assets are capitalized for tax purpose based on tax base, it means that the tax base is zero. So when you talk about the intangible asset, the tax base will always be zero. Tax base will always be zero. Goodwill are tax exempt. Goodwill are tax exempt, and then all the provisions are disallowable expenses. So all the provisions are treated as disallowable, and in that case, they are added back to the carrying amount to get the tax base. They are added back to the carrying amount to get the tax base. So they are added back to the carrying amount to get the tax base. Now let us do part B of that question. So I'm going to use a table. I'm going to use a table. Just a table, a good table that will highlight everything when doing the part B of that question. So the question was for April 2023. Let me use this table. So we shall have years. I'm going to use a black pen. So we shall have years, which is from 2019 to 2022, 2019, 2020, 2021, and then 2022. Then we shall have our carrying amount. Then we shall have our tax base, in this case. Then we shall have our temporary difference. TD is our temporary difference. Then we shall have our deferred tax. Deferred tax. So let us start the carrying amount. Let's start with the carrying amount. So the carrying amount, remember the cost. So let's compute carrying amount. So remember, carrying amount is equals to cost minus accumulated depreciation. Cost minus accumulated depreciation. So to start with 2019, it will be equal to 12 minus depreciation was 3,000. So that will be equal to 9,000. Then we have 2020, 12,000. Now accumulated depreciation now it will be 6,000 for the two periods. That will be equal to 6,000. 6,000. Then 2021 cost minus accumulated depreciation. Now accumulated depreciation in this case will be equal for the three period to be 9,000, which is we are remaining with 3,000. Then 2021 will be 12,000. Now accumulated depreciation for the whole year, for those 4 years, to be 3,000 times 4. 3,000 times 4, which is 12,000. 0. So you have a carrying amount here of 9,000, 6,000, 3,000. Then you have 0. Then computation of tax base. Let us compute tax base. And we know our tax base. Tax base is equal to cost minus accumulated capital allowance. So let us start with 2019. 12 million. So the capital allowance for the year 1 was 4,800. That one will give us 7,200. Then 2020, 12,000. The new capital allowance to be 4,800 plus the capital allowance for 2020. That is 4,800 plus that 600. How much would that be? So 4,800 plus that 600, because the capital allowance for year 2 was that 600. So you can check. We had computed that part with a 400. So meaning 12,000 minus answer, which is 3,600. Supposed to be that 600. Then 2021, it is 12. Accumulated capital allowance for that period will be equal to 4,800 for year 1. Then year 2 capital allowance was 3,600. Then year 3 in 2,400. That is 10,800. So 12,000 minus answer. This is 1,200. Then 2022, 12. So capital allowance will be 12,000. It will be 4,800 for year 1 plus that 600 for year 2. plus 2400 for year 3 plus 1200, which is 12,000, means 0. So that will be equal to 7200, that is 600. We have 1200 and then 0. Temporary difference, the difference between carrying amount minus the tax base. So the temporary difference equals to carrying amount minus the tax base. And this is 9,000 minus 7,200. That's 1,800. 6,000 minus that 600, which is 2,400. Then 3,000 minus 1,200, which is 1,800. Then 0. Then the deferred tax, now deferred tax is equals to temporary difference times the tax rate. So temporary difference times the tax rate. Now in this case, our temporary difference is 1,800 times 30%, 2,400 times 30%, 1,800 times 30%, then 0 times 30%. This is 0, so 1,800 times 30%. This is 540. Then we have 2,400. This is 720, then 1,800, which is 540. Now remember these are provisions. So remember these ones are provisions. Provisions. Now remember, do you know how to account for provisions? Now they require us to compute the deferred tax. Now deferred tax, this is how you compute the deferred tax. So deferred tax account. So the deferred tax account. So we have the balance brought down if it's deferred tax asset. So on this side, then balance brought down if deferred tax liability. Now let's go to our question. Did you have any deferred tax asset or deferred tax liability? There was no any balance. So if there was no any balance, it means that we did not have any balance brought down for the deferred tax asset or the deferred tax liability. Now, provincial. Now, the initial provincial will be credited in this account. So, which provision is that? So, provincial for deferred tax. So, this one, provincial for deferred tax liability, or the deferred. Let's say provision for the deferred tax, so as not to make work easier, work hard. So, it is 540. So, remember, this one is for 2019. So, this one we are starting with from 2019. Let's put 2019. That's for 2019. Then you get the balancing figure. So the balance carried down in this case will be 540. So provincial, we start with the first provincial. And that provincial will be credited in this account to the deferred tax. So provincial for the deferred tax is 540. Then we go to 2020 now. 2020. So we start with the balance brought down. In this case, we have the balance carried down was 540 to be the balance for the next period, 540. Then we check any provincial. So we need to check if it's an increase or a decrease. Now from 2019 to 2020, we have a decrease. So we have an increase. Now an increase is a deferred tax liability. So an increase is a deferred tax liability. So an increase of how much? So from 540 to 80. So from 540 to 720, that is an increase of 180. So we have the provincial for the deferred tax. So an increase we debit. So we credit. An increase we credit. in the deferred tax account. So an increase of how much? 180. Then we get the balance carried down. Then we balance the account. So let's balance this account. So 540 plus 180. 540 plus 180. That is 720. 720. So the balance carried down is 720. Let's go 2021. 2021. 2021. So balance brought down is the 720. Now from 20 we check if we have an increase or a decrease. So we have a decrease. Decrease. This one related to deferred tax asset of how much? So 720 to 540. We have a decrease of 180 still. So that will be the provincial for deferred tax asset. So for a decrease we debit in deferred tax account. So of 180, then we balance the account. So the balancing figure, balance carried down, to be equal to 540. So that 540 plus 180 is 720. So we get 720. Then we go to 2022, which is our last year. 2022. So we have the balance brought down, 720. Now from here, we have a decrease also. Decrease of the deferred tax asset. Of how much? 540. So we say provincial for deferred tax asset of how much? 540. Then balance carried down itakuwa ngapi? So minus 540, 180. So the balance carried down is 180. So that's how you are supposed to balance that account. That's how you are supposed to balance that account. I think we are okay now. We are okay up to that point. So that marks the end of that question. So we shall do another question, which is very, very important. Let me check if we have done it correctly. So this one is supposed to be balance carried brought down. It's supposed to balance 540. You're not supposed to have any balancing figure. So meaning we don't have the balance carried down in this case. That one is correct amount. So 540, 540 without any other balancing figure. It's supposed to balance at the end. It's supposed to balance by itself. So 540 and 540 without any other balancing figure. So that's how you are supposed to do that question. I think there is nothing more or less. There's nothing more or less in that question. Now let's do another question, and that question will be the final. Actually. The final. So April 2024, question number 2B. April 2024, question number 2B. So April 2024, question number 2 boy. So April 2024, Question number 2, boy. So April 2024. Question number 2, boy. So let's check that question for April 2024. Question number 5B. Number 2B. Question number 2B. 2B. The question is about Fora Limited. Now, on 30th June 2022, Fora Limited had a credit balance of the deferred tax. So in this case, we have been provided with the deferred tax balance, and we have been the balance is a credit balance actually. So the balance provided is a credit balance. So you need to check on that. So you need to check that the credit balance for the deferred tax account. Then you have some transaction which occurs during that year. That is June 2023, at the year ended. So number 1, we have depreciation. So 45 million was charged against the profit in respect to the depreciation. Tax computation showed that the capital allowance was 50. So we have the capital allowance of 50 and we have the depreciation of 45. So the difference will lead to what we call the deductible balance. So that will be, we shall have a deductible balance. Number 2, we have the interest receivable of 50,000 was reflected in the profit and loss for the period. However, only 45 interest was actually received during the period. Interest is not taxed until receivable. So we have been told that the interest is not taxed until receivable. So that will lead to temporary difference also. So that will lead to temporary difference. Number 3, interest payable of the 2,000 was treated as an expense for the period. However, only 28 of the interest was actually paid during the year. Also, we have the differences because that one will lead to temporary difference because interest is allowable expense for tax purposes until it is paid. Number 4, we have development costs. So development costs, as we said, will be capitalized during the year, and therefore the tax base will be 0. Number 5, we have land and building, net book value, and then we have the revaluation. That one is fine. We shall check for the. We shall also check for the value of what. We shall check for the value of the revaluation only. In that case, because we don't have the tax base, so we shall only check for the value of the revaluation because we don't have the tax base for that purpose. Then the tax. The foreign LTD has the right to offset the deferred tax and the deferred tax liability. So we are required 10 marks to determine the deferred tax liability. Now we shall start with the details. 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 Then we have our carrying amount. Then our temporary difference. Then the deferred tax. Then we shall also have the temporary difference and deferred tax. So remember, temporary difference is equal to carrying amount minus tax base. This one is the temporary difference times the tax rate. Then we can also have the nature, if it is deductible or taxable. If it is deductible or taxable. I think this one will be enough. Let us start with the first transaction, number 1. So we have depreciation and capital allowance. So depreciation and capital allowance. So I will say depreciation versus capital allowance. I will use that analogy. Now the carrying amount will be 45 million. 45 million. Then the capital allowance is 50 million. The difference is 5 million. Temporary difference. Then deferred tax times 0.3. So 5 million to be 1.5. Then nature. So it is a minus, it's a negative figure. It is a negative figure, and therefore this one is deductible. Deductible. That is number one. That is number one. So it is a deductible. So it's a deductible what? Deductible temporary difference. So it is a deductible temporary difference. Okay. Let's go to the next one. Number two, interest receivables of 50,000 was reflected in the profits for the period. However, only 45,000 of the interest was actually received during the year. Interest is not taxable until received. So we have those accounting, two different accounting period. So same item, but two different periods. So that one also read to, so interest receivable, so it is taxable when received. Remember, this one is taxed when received. So tax when received. So the carrying amount will be equal to 50,000, and the taxable is 45,000. So the difference is 5,000, which is 5,000, then 5,000 times 0.3. How much would that be? 5,000 times 0.3, 1,500. Nature, this one is taxable because it is positive taxable temporary difference. Then you can go to the next item. The next item is next item number 3. Interest payable of the 2,000 was treated as an expense for the period. However, only 28 was paid during the year. Interest is not allowed expense for the tax purpose until it is paid. That is correct. Also, we shall treat it the same as this, the first one, the interest receivable. So for payable also will be the same. Now the carrying amount will be 32. 32 what? 32,000. Then the tax base is 48,000. What was paid is the tax base. So what was paid is the tax base, or what was received. What was paid or what was received is the tax base. So the difference, 32 minus 48, is supposed to be 32,000. Is it 48 or 28? It's supposed to be 28. 28. 4,000, which is also taxable because it's positive. So 4,000 times 0.3, 1,200. Now it is opposite because this one is payable. It's what we are paying. It's supposed to be deductible. It's supposed to be deductible because it's what we are paying. So if you are receiving, so when we are interest received, 50 minus 45 is 5. It is the difference is positive. It's taxable for interest receivable. But for interest payable, the difference between the two, even if it is positive, it's supposed to be a deductible amount. It's supposed to be a deductible amount because it's an expense. Because it's an expense. So that one is deductible. Next, number 4. We have development costs. We say development costs, they are fully capitalized. So development costs, we say they are fully capitalized. Development cost, they are fully capitalized. And therefore tax base is always zero. Tax base is always zero. So let us read. During the year, further incurred a development cost of 5,600, which it has capitalized. Even though we have been told 5,600. So it was fully capitalized. So 5,600 times 30%. So 50, 500, 600, 150, 180. Sorry, supposed to be here. 500, 600 times 0.3. So this one is an asset. Taxable. So it's an asset. That one is taxable. It's positive. Then we have the last one, revaluation. Now for land and the building, we can, because we don't have the tax base for the land and the building, we can only consider the revaluation figure. Let me see. Here. Let me see. Just a moment. Um, okay, I think we can compute the tax base. Let us see. So we have land and the building. Now the cost was how much? The 49 49,00500. Aha. Then it was revalued to which figure? Let us see. Then it was revalued to 6 million. I think 6 million will be our tax base. It was revalued to 6 million. Then the difference will be our temporary difference. Let us see. The difference will be our temporary difference, which is 6 million minus 49,00500, 1099,500. So we have 1099,500. So in this case, it will be 1099,500 times 0.3. So times 0.3, 329, 850. And that is, it is deductible. That will be equal to deductible amount. Deductible amount. Now, I think we are done with that one. What was the requirement? So the requirement was for us to compute deferred tax liability. Now in this case, let us compute the deferred tax liability. But this one is for before only one period. So deferred Now, before we do the deferred tax, okay, so deferred tax liability. So deferred tax account actually. So deferred tax account. So this one was for only 1 year, which is 2023. This one is for only 2023. 2023. So balance brought down. So if you have deferred tax asset, then balance brought down if you have deferred tax liability. Now in this question, they say that the balancing figure was the deferred tax credit balance. So it was a credit balance 1340 600. 1340 600. So 1340 600. Then we need to balance the account now. Now before we balance the account, let's compute the figure. So the deferred tax total. So we add the deferred tax total. Because this one is for only 1 year, we cannot check for increase or decrease. So because it is for only 1 year. But if it was for 2021, 2022, 2023, and so on, we could have checked if we have an increase or a decrease. But because this one is for only 2023 period, then we don't have any increase or decrease, so we add them together. So minus 1500 plus 1500 minus 1200 plus 150 180 minus 329 850. This will be equal to minus 1679 370. Now this one will be, what shall we do with this amount? That one will be the we shall still have the credit balance actually. In this case, we shall have a credit balance of how much? Now because it's a balance, it's a negative figure, so we shall have a balance carried down of 1679 370. So we shall have a balancing figure of that amount. Because a negative figure, then it will be the balancing figure will be on the credit side. Will be on the credit side. Now let us see. So 1340 600 plus 16. But remember we have a revaluation somewhere. Actually, I'm sorry, we have covered the revaluation. It's okay. 1679 370. That one will be equal to amount of 30 19 970. So 30 19 970. Then balance, so we shall have, so to balance this account on this side, this will be the profit and loss. Profit and loss of how much? 30 19 970. 30 19 970. That will be deferred tax income. Deferred tax income. So if it will be on the other side, it could be the deferred tax expense. It could be the deferred tax expense. So, but that one is a deferred tax income. We can do another question, April 2022, which will be our last question. April 2022, so number 2B. So April 2022, question number 2B. So let us do the final question, that is April 2022, question number 5B. So April 2022, question number 5B. So we shall have the details, then carrying amount, then the tax base, then the temporary difference, which is carrying amount minus the tax base, then the deferred tax, which is the temporary difference, and the tax rate, then nature. So let's start with the information number 1. So Zoe Limited is a public company, it's a public limited company in the process of finishing of its financial statement for the year ended that 1st October 2021. The following information has been extracted from the accounting records for the purpose of the estimating the deferred tax balances. So remember, the deferred tax arises because of the temporary differences. Now, inventory is stated in the financial statement at the lower of the cost or the net realizable value. So remember, inventory IS2, that is for the inventory. We shall take a look at the inventory data, but you need to know that inventory measures the inventory are measured at either the lower of the cost or the net realizable value. So whichever comes first. Now the company written down value for the inventory will written down its inventory by 120,000 to the net realizable value of 1130. So 1130 is the carrying amount. So inventory. So carrying amount is 1130. Now it was written down by 1130 by 120. So you add the two. So it was written down by 120 million. So add the two. So 1130 plus 120. That is 1250. So 1250 is our tax base. So 1250 is our tax base. So 1250 is our tax base. The difference is 120 million. Then 120 times 30%. And in this case, the nature is taxable because it's a positive figure. So 1130 minus 1250. So it's negative actually. It's a negative figure, so it is deductible. It is deductible. How much? So 120 times 0.3. So that is minus 36. Minus 36. Next, trade receivables had a carrying amount of 50. We have been given the carrying amount of 450. Where is it? After making a provision for doubtful debt of 30. So remember, provisions are not taxable, and we said any provision we add them back to get the tax base. So receivables. So receivables is 450. Then from the 450, we had a provision. So we said provision, we are supposed to add them back. That to get the tax base of 480. 480. Difference is minus 30. So the difference is minus 30. So 30 times 0.3, I think it is 9. So minus 9. So that is minus 9. So that one is minus 9. That is correct. Number 3. Number 3 is about property, plant and equipment, PPE. Now PPE are the carrying amount of that 3050 and the tax base of 2750. So this one will be given 3050. So PPE 3050 and the other one is 2750. That one is direct. But remember, you have a revaluation. This revaluation now we shall consider it separately. So in this case, we shall not consider revaluation, but we shall do it when we will be doing our tax account 2750. So 3050 minus 2750 is 300. So 300 times 0.3, 90. This is deductible. Then this one is taxable. The nature is taxable. So remember, we have a revaluation somewhere of 150. So revaluation of 150, put a star. We shall take a look at it later. But was it considered there? Let us see. 2750. So it was not considered when computing the tax base. It was not considered. So that revaluation we shall do it separately. Number 4. During the year ended 31st October, the development cost of 80 was capitalized. So when you see the word capitalized, that means that tax base is 0. So development cost. So you need to know that the tax base is 0. But the other one is for 80. We had an amortization of 20, so that one is for 60. We shall get for 60. So for 60, then for 60 times 0.3. So we had an amortization rate, amortization value of 20. So we need to deduct. So for 60 times 0.3, 138. Also taxable. Then after that part, we have the payables, trade and other payables was carried at 600. So 600 obviously is our carrying amount. So payables. So it was carried at 600. So let us put a negative because it's a liability, so that we know it's a liability. And then including other payables are accrued expense of 100, whose related expense are deductible. They are deductible, meaning we need to deduct from this pot. So if it is 600, others 100, we need to deduct. So 500. So 600 minus 500. So it is minus 100. So it's the opposite of the other one. So 100 and 0.3. That or if you say 600 minus 500 is 100, but because it's a liability, then it will be deductible, positive. But if it's an asset, for example, an asset 3050 2750, we get a positive figure, is taxable. But for payables, because of liability, 600 minus 500 is a positive figure, becomes deductible. So in this case, it's a deductible. We shall confirm with the other one that we did in our previous item. Then you compare. Then I think it is complete. Now we can get our deferred tax. So by adding those items, so we have minus 36. So we have minus 36 minus 9 plus 90 plus 138 minus 30. So I'm getting 153. So we shall not consider either a decrease or an increase because it's only for 2023. For 2021, because it's only for 2021. So we cannot consider any increase or decrease when you have only one period. So we only consider when you have an increase or decrease when you have different period. In this case for 2021 only, and therefore we are not going to consider either decrease or increase. Now let's compute our deferred tax account. So deferred tax account. So we shall have a balance brought down if you have a deferred tax asset, and we shall have balance brought down if you have a deferred tax liability. Now, from the question, information number 7, number 6, deferred tax liability was 272 million. So we know it is 272 million. So it's a liability. Now, we did not consider the valuation, so we shall consider the valuation now here. The valuation, it was 150 times 30%. So we had not considered it. Now it is time to consider it. So 150 times 0.3, 45. Then the balance carried down, it's a positive figure, 153. So because if it was a negative figure, the balancing figure will be on this side. Balance carried down could be on that side. So 272 plus 45, that is 317. 317. Then the balancing figure, 164. Now this 164 is the deferred tax asset. It's a deferred tax asset, P&L. So we say profit and loss. Profit and loss, which is a deferred tax income, not asset, of 163. So that one marks the end of our income tax. So the rest of the notes I shared in your group for the income tax. So go and review now other notes from your group. I shared the IS 12, the income tax. So that one marks the end of our class today. So when we meet again, we are going to do inventory. So when we meet again, we are going to do IS2 inventory. Then we also do lease if time allows, and the leases. So that's all about it for today. Let us meet for leases class in our next class.